Hello ladies and gentlemen, it is David here. Now in this video I've got some good news for those of you looking to buy this year, because mortgage rates have just hit their lowest point in the whole of 2025. Now in this video I'm going to be breaking down the key economic data that might suggest that rates could even be going lower, how to interpret that information yourselves, and what it means for your buying power. So without further ado, let's kind of dive straight into stuff. Okay, so right now we're looking at the 30-year fixed rate mortgage back to January this year. Now you can see, start of 2025, we were looking at mortgage rates up at 7.13%. They then sort of dropped quite a bit towards sort of April time. There was a low of sort of 6.6. And then ever since then, we've sort of been trending in this sort of 6.8 to 7% range. But start of this month, a week or so ago, you can see they dropped right down to sort of the 6.5. So right now we're sort of hovering around about the 6.56 mark. To really kind of understand, what's been happening in the mortgage market and where they might be going in the sort of next sort of few months, we should really look at their relationship to the wider investment market, the bond market, the investment market, where institutional investors are buying securities all over the place. So for that, let's head over to the 10-year Treasury. Okay, so right now we're looking at the 10-year Treasury graph here that goes back to, goes back a year. You can see we're hovering around about the 4.3 mark. Now, what is a Treasury? Well, essentially the 10-year Treasury is the return that the US government will pay anyone that lends them money for 10 years. It's under a bond, essentially. And the 30-year fixed rate mortgage is closely tied to this. So this graph here shows the 30-year fixed rate versus the 10-year Treasury. And you can see whenever the 10-year Treasury moves, the 30-year fixed rate closely follows. Now, generally speaking, the 30-year mortgage is going to be around about a couple of percentage points above where the 10-year Treasury is, okay? Because obviously if you are lending out money for a mortgage, there's going to be a risk premium, okay, a couple of percentage points risk premium. But you can see right now we are looking at, as I say, fixed rate of about 6.5%. Now this yield here fluctuates daily, okay? It depends on how many people are buying them, okay? If you get a flood of people wanting to buy 10-year Treasuries, then the price is going to go up, which means the return that the government will pay is going to be less, right? It's an inverse relationship. So when fewer people are buying 10-year Treasuries, the yield goes up. And that's in any sort of investment, really, whether you're talking about real estate, bonds, all that sort of stuff. Now, if we go back to the 30-year fixed rate graph here, as I say, you can see at the start of August, rates significantly dropped by about a couple of basis points, basically. No, about 25 basis points. And the question is why? Why would they suddenly drop that much? Well, this comes down to the markets, the overall investment market's inflation expectations. Now, many people expected inflation to go up, specifically over the past couple of months when the Trump administration started putting tariffs on all sorts of countries worldwide, making it more expensive for exporters to get their products and services into the US, right? So many people thought, or the market, should I say, thought, people who, the investment market, the bankers on Wall Street, the institutional investors, they all thought that was going to be very inflationary, because they thought those increased costs from those exporters because of the US tariffs would eventually be passed on to the American consumer. But the latest inflation data was released last week, and it kind of goes to show that this isn't what I want here. Let's edit this graph a little bit. Now, last week inflation data was released, and it actually came out a lot lower than a lot of the institutional investors and people were thinking. And you can see here, it actually is up at 2.73%. People were expecting much higher than that. And I think what has happened here is that many of the price increases caused by the tariffs that people were thinking was going to be passed on to the American consumer has generally been absorbed either by the exporter or by the person buying those goods or services here in the US. They seem a little afraid to be passing on those extra costs to the consumer. And why is that? Well, because inflation over the past 5 years has stretched a lot of people's budgets, and people are kind of at their wits' end with it, really. So with inflation being less than people were thinking it was going to be, it actually gives more confidence to the Federal Reserve to drop their interest rate lower next month when they meet in September. And that's what the market has been pricing in, and therefore is what we're seeing in the Treasury market here, the drop in the yields there, and equally the drop in the 30-year fixed rate. Okay, so essentially it comes down to the inflation expectation has not been as high as people were thinking, and therefore people believing that the Federal Reserve, in order to sort of kickstart the economy a little bit, may drop the Fed funds rate, which is essentially the rate of which all of the debts are based off, down when they meet in a few weeks' time. So in fact, speaking of which, let's move on to that, because there's a really cool graph here on FedWatch. Essentially what this is it looks at what the wider investment world think is going to happen when the Federal Reserve meet next month. Are they going to keep interest rates the same, or are they going to drop the base rate? And as you can see, 92% of the transactions that are going ahead in the market now are pricing in this rate cut. Okay, so only 8% of people think that that things are going to stay kind of where they are. So really interesting graph, and again I'll put the links to this down in the video description below. But looking at this, looking at the CPI, looking at the 10-year Treasury, looking at 30-year fixed rate mortgages, and looking at the relationship between the 30-year fixed rate and 10-year Treasury notes, you can use all this data to try and work out where mortgage rates are going to be in a couple of months' time, further down the line later this year, and whether or not it's a good time for you to buy now or sit and wait. Now, of course, the problem with sitting and waiting is that if rates do go down, then you may end up with more competition as more buyers come into the marketplace, which could put more pressure on you as a buyer to get a good deal. Right now, there's still a lot of inventory out there in the sort of local and wider market here in Florida. So whether or not it's up to you to wait, it's a little bit of a risk, but I certainly would recommend you at least start getting your finances in order, and getting those mortgage in principles potentially agreed, or at least reaching out to a broker if you are intending to move in the second half of 2025, because we look to be entering sort of more favorable conditions for buyers from a lending perspective. Okay, I can't see that rates are going to go up a huge amount, especially if we continue seeing what we're seeing in the wider investment world, if we continue seeing what's happening with inflation, if we continue seeing the less severe impacts of the tariffs that people were thinking of. But of course, what we don't want to happen is for rates to continue dropping too much, because obviously that would indicate that there is a wider problem in the economy, whether it's jobs, whether it's inflation. We don't want that happening. So there's a fine balance that you need to have there. Now, if you want to see exactly how mortgage rates are going to impact your buyer power in the second half of 2025, reach out to me and I'm happily run some numbers for you. Otherwise, thank you for watching, and I'll see you again in the next video.